the Fed's balance sheet needs to expand in commensurate with our GDP to help us grow. And so quantitative tightening ended today.
Banning our money supply because the Fed has been restricted. I'm going to explain that.
Credit card loans, car loans, those are short-term borrowing rates, and they are low right now.
Microsoft and Google came out and said, we're not going to reduce our billions of dollars of spending. Existing home sales, 4 million home sales annual rate. That's with a little drop.
Hey, it's KP coming to you live from Laguna Beach. You're at the CMBA board retreat. We've got some heavy hitters here. Hello. All right. My work travel is not done, in case you couldn't hear right there. This is the California Mortgage Banker Association's board retreat. So this is our last board meeting of the year. Paul Gelati is in charge and doing a fantastic job. And Susan Milazzo is with us for a year, consulting, having a nice smooth handoff, and it's been amazing. So this is our opening reception. So my travel is done. I saw a couple day trips here and there, but this is in Laguna Beach, and I live about 35 minutes from here. So this is a place called The Ranch. It's a beautiful resort. There's a dude out here all by himself freezing, playing guitar. So I'm going to go give him some company. Okay, so what I'm going to talk about, super quick video because not a lot's going on right now. But don't fight the Fed. That's the bottom line. And I'll give you a couple reasons why, but also why it doesn't really matter. Let's go. Let's go. All right. So it was a news alert today that the Fed chair replacement to Jerome Powell has been named. And it doesn't matter because the Fed is always slow. They're always behind, no matter who's there and trying to corral. So maybe a new chair will kind of quicken their pace, but the market leads the Fed every time. If just watch the market rates, watch the 2-year treasury, watch the 10-year. The Fed, they have a dual mandate, and everyone talks about price stability, inflation control, and maximum employment, which is obviously trying to make sure that we don't go above this 4.4% unemployment rate that we're at, and have a bout of deflation. Because remember, there's nothing more deflationary than when your income goes to zero, and we know labor is softening. But the institutional traders that trade bonds, they are always out in front leading the Fed. They are always dictating the next move. Look at the 2-year treasury. Like, it has clear cut for a 25 basis point cut. I don't know if it'll happen. I think it'll happen. I'm leaning towards it'll happen. But if it's unlikely to happen, it's because the markets are telling the Fed what to do. And the Fed is always slow to react. And so I don't, to be honest with you, I don't really care who the next chairperson is, male or female. So having said that, the Fed, we talk about that dual mandate, but you hear me talk about a tri-mandate all the time, which is stability of long-term rates. And that comes from funding our government. They work together with the Department of Treasury, which is headed by Treasury Secretary Scott Bessent, to fund our spending. And so we have a liquidity problem. And Bill Bodnar from Tabrasa brought it up on a post last week. I talk about it a lot too. And I think it's something needs to be underscored here. The Fed's balance sheet is about $6 trillion, okay? And they need their balance sheet to be about 20% of our GDP, which is 30 trillion. And so it's right there. And if we're going to grow at 3 to 4%, okay, which whatever the GDP number is going to be for next year, I don't know what it's going to be, but the Fed's balance sheet needs to expand in commensurate with our GDP to help us grow. And so quantitative tightening ended today. it's no coincidence. I mean, almost perfectly timed to being 20% Fed balance sheet to our economy in terms of dollars. And so, are we going to grow? Do we want to grow? Are we going to grow our GDP as a country? We need employment. We need money. We need liquidity. And if our rates are too high and too restrictive, we don't have that. And so that's why they got to cut. So if they skip this meeting because of the data being, lagging or whatever, I keep reading all this stuff about inflation. Look, PCE's coming out this week. Are we at 2.7% core PCE? Core PCE is what the Fed looks at. We get a PCE, personal consumption expenditure, which is a 12-month indice. There's a reading every month, and all 12 of those months together make up that number. What happened 12 months ago? Does it really matter for our economy? I mean, in real terms and in real time, not really. That's why the market always is out in front and ahead of the Fed, because they're looking at old data. And I get it. They don't want to make a mistake. They don't want to, you know, overcorrect and have inflation flare up. But then, they potentially move us into a recession, which we've had a rolling recession. We've had a manufacturing recession. We've had a housing recession. We all know that very well. And so the Fed's balance sheet is a big deal. And so, worker productivity is increasing. AI is, making its mark. There's a lot of capital expenditure out there. The One Big Beautiful Bill has a lot of front-loaded tax breaks, and we'll realize that here. And certainly for probably the first, 3 to 6 months of 2026. So it is a slower time of the year. People who own a home, of course, they're decreasing their listings. They want some stranger walking to their house from Thanksgiving and New Year's. Get the hell out of my house. I'm not moving. It's just too troublesome during the holidays. So, what's been great, though, is that purchase business has been really good in the fall because lower rates cures a lot. But you'll see listings go down and you'll see business generally go down, but we could have some refi uptick if rates stay in this range. And today, technically, the 10-year Treasury erased all of last week's kind of light trading Thanksgiving week, bond market movement. We got down to 4%, a little under 4%. Now we're right back up to 409, but we're not at 420. We're not at 440. We're not at 460. We're not at 40. We're certainly not at 5% on a 10-year Treasury, which is what all the doomsayers have been saying, and they've been wrong, wrong, wrong. So, I don't know where we're going to land or what the data is going to say, but we're in a range and it's good. So, earnings season's generally over, and we're going to cruise into the holidays and just surf for success, as our retail channel director, Chris Sorensen, likes to say, and enjoy family time. I hope everyone had a wonderful Thanksgiving. And that's it. Quick little 7-minute video. Have a good one. Cheers.
Hey, it's KP coming to you live from Corona, California. It's about 8:45. Just witnessed my Cowboys pretty much throw away their playoff hopes, but the Eagles could choke. They got 5 games left, just like they choked on a 21-point lead to the Cowboys. So we shall see. How is the consumer doing after Black Friday, Cyber Monday, Giving Tuesday, all the things? What's the Fed going to do next week? How's inflation and how's the labor market working? And what is going on with the flow of money around the world? We'll get into the stock markets, crypto, and all that good stuff. So stay tuned. Okay, so we don't have a jobs report tomorrow. Didn't have the JOLTS report this week. We had continuing claims today, a little lower than normal, but the initial jobless claims on a weekly basis, a little lower than normal. But the continuing claims have remained elevated. Still over 1.9 million people out of work. And then after 26 weeks, they fall out of the report. And I believe over 25%, something like 25% of all job searchers have been out of work for over 26 weeks, half a year. That's not a strong labor market. Now, it's not broken, but it's certainly softening and weakening. And so when you don't have those major reports, what do you look to? You look to something like the ADP report, which came out, which has taken center stage since the government shutdown. And so 32,000 jobs were lost in the month of November. Now, that is a net. Now, if you look under the hood there, over 120,000 jobs were lost by small businesses defined as 50 employees or less. And so, small business, I believe, is defined as like 500 employees or less. which employs about 55% of all Americans that are working. So it's not a good sign. And, some people could point to tariffs. Some people can point to people losing jobs and not spending money. Some people can point to, just how expensive everything is and how expensive money is. And so, it's a little bit of everything, obviously, but it's a weakening labor market. Now, it wasn't a loss of 120,000 net because companies with 500 employees, were net increase of 51,000 workers. So you're kind of seeing this economy of scale thing working. Could AI have something to do with it? Maybe just better run businesses because they've been around longer and they're bigger and they can kind of navigate whatever comes their way when the economy goes through challenges. I don't have the answer, but I know the data is showing more labor weakening. And that's probably the main reason why I think there'll be a hawkish cut next week when the Fed meets on the 10th. A 25 basis point cut, that probably don't want to kill the stock market and the stock market rally, the Santa Claus rally. And they probably just want to say, we're done cutting for a while and we're going to watch the data the rest of next year. And so that's just my guess. Now, we get PCE tomorrow, the personal consumption expenditure, which is the Fed's preferred measure of inflation. It's actually kind of released at an odd time. It's usually the end of the month, and then it's first thing in the morning. It's kind of released on this Friday, first Friday of the month of December, and a little bit later in the morning. It's interesting. I was talking to Mark Hansen. He comments down here a lot. Great guy in the home equity agreement and investment space. He said something that I've been saying a long time. And there's PCE headline, headline CPI, and there's core, right? And so the core strips out food and energy because it's volatile. Energy has not been volatile. For a year, it's been low. It has not been volatile. So I get it that, it could be volatile on a month-to-month basis, but it's been pretty anchored around $60 a barrel, thus gasoline and heating, all that kind of stuff, has been pretty low. And so what will likely happen tomorrow, like it has been, is the headline number will be around 2.7, and then the core, minus that anchoring effect of cheap gas, will be a little higher. So when you strip out food and energy, and by the way, food has been going up at a less ferocious pace. Everything's still generally going up, but when they say inflation's coming down, the rate of it increasing is slowing. So we could see 2.9 on the core reading, maybe 2.8, just depending on how much the housing component, which is a smaller component in PCE than CPI, how much of that slowing, which we all know, our industry's been in a rolling recession, will show up in the numbers. So we're getting information on the inflation part of the mandate. But the reality is there's getting a little bit less liquidity. Just want to hammer home that point I made on my video Monday night. The Fed balance sheet has shrunk. Quantitative tightening has stopped, and it's about 20% the size of our economy, the Fed balance sheet. And so if we want to grow this economy and grow a way out of it and, help foster job growth, we need more money in the system. I'm not saying zero interest rate policy. I'm just saying we've been taking a measured approach. It's only been 150 basis points of cuts since the Fed stopped hiking. It's been a couple years. So it's been a very slow, dare I say, soft landing. And so, we've got the last word tomorrow. We'll talk about some more of this stuff. My guess next week is President Trump will announce the new Fed chair, like right in the middle of Jay Powell's press conference. That's just my fun thing to say. I will say, how are larger companies doing? The S&P 500, the 500 largest publicly traded companies, there's only, I think 97% of them, 487 companies have reported earnings for the third quarter. We're in the middle, towards the end of the fourth quarter. 85% are beating estimates, 13% earnings growth this year. We're projected to see about the same next year. That's what's lifting the stock market. I am not a financial advisor. I'm not responsible for your losses, only your profits. But when big companies that are publicly traded make money and continue to do so and continue to guide forward, they will continue to do so, then the stocks generally want to go up. And if there is cheaper money into the system to help out small businesses and consumers with cheaper, financing for, mortgages, car loans, personal loans, and small business loans, well, the larger companies tend to benefit. Not all of them, but, a lot of them do. And then there's more money in the system. So, I think a Santa Claus rally is fully intact. I don't think the Fed wants to pour cold water or snow on the Santa Claus rally. So I'm a big fan of where earnings is going in large business. So another market, how the consumer is doing. Black Friday is up, excluding autos, about 4.1% year over year, according to MasterCard Spending Pulse. We may have a $1 trillion holiday spending season, first one ever in America. In China, they like their shopping day is like it's out of control. But we are seeing the K-shaped economy, according to Walmart. They are saying that the lower end of the income earners are buying more things like necessities rather than discretionary stuff. So again, that lift is needed there to help out the bottom half of the K. Speaking of Walmart, they're delivering drone deliveries. They've been doing it in Dallas, and now they're doing it in Atlanta. 6 stores on the outskirts of Atlanta are going to do that for last-minute purchases, drone delivery. Remember we were talking about Amazon doing that? Well, Walmart's doing it. And they're going to open up in other parts of the country, like Charlotte, Houston, Orlando, and Tampa. By the way, you want to take an eVTOL, vertical takeoff and landing. Actually, it's called a EV TOL, eVTOL, right? Takeoff and landing. These kind of small drone mini helicopters, lightweight, less fuel. They're going to start in a couple of years in Miami. So a company called Archer is kind of leading the way there. So I thought that was a pretty cool thing. So again, I think the Fed is going to cut next week. I think it's a hawkish cut. I don't think the members are going to stray from their dot plot 12 weeks ago or 11 weeks ago today, but next week we'll see another dot plot. So that gives them the cover to do a hawkish cut and then say what they think. And it will be important to kind of hear what they're thinking. But again, I don't think it really matters the makeup of the board too much because the market leads the Fed. The 2-year Treasury is at 352. That's clear cut for another 25 basis points. The 10-year Treasury can't seem to get above 409, 410, 413. We're not at 420, not at 440, And so the other really big event next week, and this is kind of low key under the radar, the Bank of Japan, also their central bank, they are kind of foreshadowing that they may raise their interest rates. They've had a lost decade or two from having cheap money. There's this yen carry trade, which has been like a very highly leveraged trade, which we've seen cause blowups in financial markets. So my guess is some of this unwinding since October 20th in the stock market, in crypto, might be some of these over-levered funds getting out in front of the Bank of Japan, potentially raising rates. So it's a big market mover for the flow of money around the world. China, not doing great, propping up with their manipulated renminbi, their currency, buying gold, although that's paused as well, although it could take off, especially if the Fed does cut rates. And it's usually seen as an inflation hedge. If the Fed cuts rates, then inflation's supposed to go up, just like tariffs are supposed to cause the end of the world. By the way, like one of the things I want to talk about, if you've waited this long, I'm almost done. But just think about everyone all year who are doomsayers. They've been wrong. They've been wrong all year about mortgage interest rates, the strength of the economy, the stock market, cryptocurrency, all these asset classes that generally want to go up because we're in a growing economy. So just remember where you get your news. Here, we like to get data and look at it and not look at rose, tinted glasses. I mean, there's some stuff coming around the corner like, home price appreciation isn't exactly doing well. We may have a flat year or a smidge of a year increase. That's not good news. I'm willing to admit that. Of course, I want home prices to go up for those of us that own homes. But interesting spin here. And another thing I've been talking about wage growth a ton. If wages keep growing at 4%, inflation generally is under 3%, 2.7, 2.6, 2.8, whatever, and home prices aren't going up as much, that does bring some more borrowers back into the market as interest rates come down. That is a win for affordable housing. So, the recap of our California Mortgage Banker Association meeting, we were talking a lot about the insurance crisis and, keep banging on, California and Sacramento to make sure they don't put arbitrary caps on insurance companies, which then trickle across the entire country for everybody's insurance rates. So lots going on this week. Have a wonderful weekend, and we'll get back to you next week. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.